Hello, I'm Jebakruba Roslin. I happily welcome you all for a new video from my channel. Before starting the video, I just want to share my gratitude for the support you are giving for my channel, and particularly the previous video which I have uploaded on accounting for management has got lot of appreciation and also many new subscribers. And today it is going to be a second video in the topic accounting for management. As I told you already, today we are going to see basic accounting terminologies. Okay, as I say, you always do watch this video completely and also share your feedback. And if you are new to this channel, don't forget to subscribe this channel. Right, without further delay, let us get into the video. Basic accounting terminology. The first terminology we are going to see is transaction. An activity which involves transfer of money or money's worth. Money's worth means goods, service, ideas from one person to another. Okay. So what does we say as a transaction? Okay. Anything, any activity where, okay, it involves transfer. Either money is transferred or something which is worth of money, maybe a goods or service or even an idea is being transferred from one person to another. So generally transaction is classified as cash transaction and credit transaction. What does it mean by a cash transaction? Cash transaction is a transaction where the cash is transferred immediately or at the time of transaction. Credit transaction is a transaction where cash is promised to be transferred in a future date. Cash is not being transferred immediately. So that is called a credit transaction. Account. What do you mean by account? It is the basic unit for measurement in accounting. So we have different units of measurement in different places. In accounting, we use the term account for measuring. It is used for identifying a person or an item in accounting, right? So identifying a person means some name, Rajesh, Suresh, right? Rajesh account, Suresh account, or an item like purchase, sales, purchase return, sales return, okay, or an item in accounting. An account is opened individually for a person, asset, expense, income, etc. In ledger, an account is a summary of transaction under a head. So generally we open separate account for different person, separate account for different asset, separate account for different expenses and income, etc. Particularly when you take ledger, okay, in the ledger book, I know we have summary. We have, for example, if it is a purchase as an account, we have a separate detail about all the transaction related to purchase under the head of purchase. So that's why it is a summary of transaction under a head. What is a capital? It is the amount invested by the owner or proprietor in an organization. Owner or proprietor is the person who is starting the business. Okay. So if he is investing money into the business, then the money is said to be capital. So what happened to the money in the due course of business? The money, the capital get increases when the business is getting profit and additional capital is introduced. So for example, the initial capital of the business is 10 lakh and the business is getting a profit of 1 lakh at the end of the year. Now the capital becomes 11 lakhs, right? Or else the business is started with 10 lakhs and after 6 months again the owner is investing 12 lakhs. The capital becomes 2 lakhs. The capital becomes totally 12 lakhs. And is there any possibility of decrease in the capital? Yes, it decreases when business faces loss and amount is withdrawn by the owner for his personal use. So for example, the business is being started with 10 lakh. but at the end of the year the business have faced a loss of 1 lakh. Now the capital becomes 9 lakh. And similarly, the business started with a 10 lakh. In due course of time, the owner withdraws 50,000 for his personal use. Now the capital is becoming 9 lakh 50,000. Right? Drawing. So what is mean by a drawings? As I told you already, if the owner is investing money to the business, then it is termed as capital. Similarly, it is drawing is the amount of cash or value of goods, asset, etc. withdrawn from the business by the owner for the personal use of the owner. Okay. So the owner may take money from the business for his personal use, or sometimes he may take the goods in the business for his personal use. Okay, so either he takes money or he takes the goods for his personal use, then that amount of goods or money he has withdrawn from the business is said to be drawings. What is a voucher? Any written or printed document in support of a business transaction is called a voucher. So we already know what is business transaction. And in business transaction, every transaction needs a proof. The proof, either it may be in a written form or it may be in a printed form, it should support the business transaction. So examples of such things are cash receipt, invoice, cash memo, bank pay-in slip, etc. Here now I have shared you an example of a voucher. Here this voucher gives you information about an office equipment is being purchased for rupees 5,000. So this particular voucher gives you a detailed about from where it is being purchased and what is the amount and what is the date of purchase. All that is available. So any written document or printed document which supports the business transaction or which act as a proof for business transaction is said to be a voucher. Invoice. It is a statement prepared by a seller of goods to be sent to the buyer. It shows detail of quantity, price, value, etc. of the goods and any discount given, finally showing the net amount payable by the buyer. Okay, invoice is also a voucher, right? Again, this invoice is exclusively prepared by a seller. And why does the seller prepare this invoice? This invoice gives a detail about what amount of what quantity of goods is being purchased, what is the price of a single quantity, and what is the total amount to be paid. Is there is any discount, either cash discount or trade discount is given for this particular purchase, and if so, after deducting that discount, what is the net amount to be payable. So all this information will be seen in a voucher. You can see the example. So this is a partial of two ship pro forma invoice. So here it is a blank voucher where you don't have any information, but it has content related to quantity and description of the item and country of origin, unit wise, unit value and the total thing, and you have a final shipping charges and total invoice amount. So this is how. So there may be slight variation, but the basic content available is quantity, price, value, right? Goods. It includes article, things or commodities in which a business is dealing with. Okay, what is about a business? Business is all about buying and selling, and sometimes buying, producing and selling, right? So those articles we bought in business for the purpose of selling, okay, those we buy and sell, that particular thing is said to be a goods. That's why it is article or thing or commodity in which the business is dealing with. Purchases. So purchases is a form of goods account. Buying of goods with the intention of resale is called purchases. So generally, for example, we are purchasing machinery for our business. Then it is why we are purchasing machinery for our business, that is to manufacture goods. We are buying machinery for our business, so that will be treated as a separate machinery account. Whereas when we buy something in a business just for the purpose of resale, then it is not mentioned in the name of the product, it is mentioned as purchase. Okay, buying of goods with the intention of resale is called purchases. Purchase return. When goods bought or returned to supplier, it is known as purchase return or return outwards. So we are purchasing from our supplier and we are finding that something is not matching our expectation or it is being get damaged. What we do? We return the purchase good to our supplier, and it is separately, it is not adjusted in the purchase account, it is separately treated as a purchase return account. And it is also known as return outward. Why? Because the goods which have already come inside the business is again returned outwards. That's why it is also known as return outward. Sales. When goods meant for resale or sold, it is called sales. So when goods meant for resale is purchased, that is treated as purchase account. Similarly, when goods meant for resale is being sold, then that is treated as sales. Sales returns. So when goods are returned by the customer, it is called as sales return or return inward. So just like when we are not satisfied by the purchase, we return the purchase and it becomes purchase return. Similarly, sometimes when our supplier are not satisfied by the goods supplied, they may return it back to the business, and that return is not adjusted with the sales account. It is separately treated as sales return, and it is also known as return inward because goods gone out of business is returned back to the return inside the business. That's why it is called as return inward. Stock. What is mean by a stock? Unsold goods lying in a business on a particular date are known as stock. Okay, so stock is also a goods account. Okay, again, I know already we have seen four form of goods account, that is purchase, purchase return, sales, sales return. Stock is also a form of goods account, that is the goods in our business, I mean in our godown. Okay, the value of goods in our godown at any particular date. So today I am going and saying that I have 1 lakh worth of goods in my godown, then my stock value is 1 lakh. Okay, so generally the stock value is noted at the beginning of an accounting period. An accounting period generally may start at April 1 of a particular year and end at March 31st of the next year. And some company do stick with the calendar year also. So at the beginning of the accounting period, that is April 1, if the stock is being verified, the worth of the quality or the value of the stock in the godown is said to be opening stock, and at the end of the March 31st, if we are calculating the value of the stock, then it is said to be closing stock. This year closing stock will be the opening stock for the next year. It is the amount receivable or realized from sale of goods and earning from interest, dividend, commission, etc. So, the different ways by which the business is receiving money, that is said to be income, and the primary source of a business is through sales. Okay, by selling your product or service, we are receiving money, that is the main source of income. And not only that, in addition to it, we might have invested somewhere, for that we may get dividend. In our business we may get some commission, and we may give loan to someone, for that we are getting some interest. All that are considered as income. Expenses. So expenses is exactly opposite to income. It is the amount incurred in order to produce and sell the goods and services. So again, we pay money to run the business. We pay money to purchase the product. We pay money to our workers. We pay money to run the machine. We pay money to the government as taxes. So anything which we pay in business, okay, anything which we spend in our business to produce and sell the goods, then that is said to be expense. Solvency. Solvency is the capability of a person or an enterprise to pay the debts. Okay, business itself, it's all giving and taking, right? We may get goods from someone for credit, and we may sell goods to someone for credit. But whenever we are buying something for credit, we have to see to that, are we in a position to return it back? So if we are capable of returning, if we are sound enough to return our debts, to meet our debts, then it is said to be solvency. Insolvency. So as you understand solvency, insolvency is the incapability of a person or an enterprise to pay the debts. And we have some debts, and suddenly things are not going as per our expectation, and we became incapable to settle our debts. Then that condition, that situation is known as insolvency. Any physical thing or right owned that has a monetary value is called asset. Okay, and we have previously seen about goods. Anything which is bought for the purpose of resale, then it is said to be goods. And anything which is not bought for the purpose of resale, but to stay with the business and for the purpose of business, for the usage of business, then it is said to be asset, and that should have some monetary value. Asset is also further classified as tangible and intangible assets. So tangible assets means those assets which we can touch and feel, then it is said to be tangible assets, like building, machineries, vehicles. And those assets which you cannot touch and feel, but still it is and has a monetary value and useful for a business, then it is said to be intangible assets, like patent, trademark, copyrights, softwares, all that are intangible assets. And we also classified as asset as current assets and fixed asset. What is current assets? Those assets which are rotated in business within a period of 1 year, within one accounting period, then that is said to be current assets. And those assets which comes inside a business for a purpose of staying with the business more than 1 year, then it is said to be a fixed assets. Liability. It refers to the financial obligation of the business. This denotes the amount which business owed to others. So as I told you that I know in business we borrow something from others, right? I mean, for example, first borrowing is the business is borrowing money from the owner, capital, and it may borrow money for further expansion from a bank, a loan, and it may borrow goods from the supplier and promise it to pay on a future date, creditors, right? And it may have other services received from somebody and promise to pay for the service in a future date, bills payable. So all this financial obligation where the other person have completed their work and business have to settle it back, then it is said to be liability. A person who receives a benefit without giving money or money's worth immediately, but liable to pay in future or in due course of time. Okay, so in business, when we are selling our goods and services, so there are chances that people also buy it for cash or people also buy it for credit. When our customer buy the goods and services for credit and promise to pay for the goods and services in a future date or in due course of time, then that worth of money, good product or service which is sold for credit is said to be debtor. Creditor. A person who gives a benefit without receiving money or money's worth immediately but to claim in future date. So just like we may sell goods in credit and may receive the amount in future date, similarly we may also buy some goods in credit and promise to pay it in a future date. So that portion of product or service for which we have to pay the money in a future date, then it is said to be creditor. It refers to the gradual reduction in the value of fixed asset due to usage and passage of time. Take for example, we are buying an automobile. Okay, the day one, the pickup of automobile will be excellent. But after a particular usage, after 3 months or 4 months, the pickup will not be same as that of the first day, right? So that is what generally happen with fixed asset. The worth, the value of the asset will be getting deteriorated over a period of time. So that reduction in the value of the asset over a period of time due to usage, then that deduction in value is what we call it as depreciation. Bad debt. So it is the loss to the business arising out of the failure of a debtor to pay the dues. It is irrecoverable debt. So already I was telling you about the debtor. Who is a debtor? A debtor is someone who is purchasing goods or services from us but promises to pay for that goods and service on a future date. Suppose that person who has promised to pay it on a future date fails to pay the amount or become insolvent, so that there is no chance of him settling the amount, then that portion of amount promised by the particular person becomes a bad debt. For example, totally we have some 1 lakh of debt. In that, a person who bought for 5,000 became insolvent. He became incapable to settle the 5,000. Now that 5,000 will become a bad debt for us, right? Thank you. I know this video has given you an overview about the various terms used in accounting, and I have covered so many terms which I felt need to be refreshed to understand the accounting concepts. But there may be also some other terms. I know, do you give in comments what are the other terms you need to be refreshed? So if I happen to find more terms which I have to refresh, I will also upload accounting terminology part 2. And if any terms which I happen to see new when I'm explaining other video, I will explain that, and then I will start explaining the concept. And if you find this video useful, kindly like this video, share this video with your friends, and also give your valuable comments. And if you are new to this channel, don't forget to subscribe this channel. And in the next video, I am planning to tell about accounting cycle. Thank you. Thank you so much.